Welcome back, Ajay. We're still with us, Ajay Srivastava of Dimensions Corporate Finance. Ajay, thanks for waiting. Just on the editors roundtable show, when we were speaking with you, and a question on asset allocation was thrown your way. You said basically the split was 50-50 between debt and equity. With what the RBI has done today, I mean, yields are moving sharply. They fell at least 8-10 basis points. Does that change at all? I mean, is this a broader indication of that we're done with this hiking cycle? What's your sense?
See, I think hiking cycle, perhaps yes, but I think the depositors will get better money than this. There's no doubt in my mind that you cannot force artificially rates down. Government will try it, RBI will try it, market will dictate the own pricing. So in my view, the fact remains that if the stance is the RBI is going to be actually de facto take away liquidity in the system, there is no way you will not get better rates. So, but you can keep waiting for the extra 5% or 5 basis points or 10 basis points. But the fact remains that the allocations still remain the same. And I think if you have got unfinished business with the debt market, and which is what the RBI wants you to do, that you go buy it and book your debentures or book your fixed deposit and so on and so forth, so that liquidity comes back to the system. I think that's what the RBI is asking you to do. So allocation remains the same. And why I said equity 50% is that lots of sectors of this market have corrected, underperformed, and therefore they will start to give you little better returns over the next 12 to 18 month period. Generally speaking, as I said, banks will give you lower return than most industrial sectors. So allocation remains the same. And hopefully there'll be some money coming back to the REITs, which have suffered a pretty bad run in the last 1 month and which are wonderful return products. So I think you will see return to equity, better returns, dividend yield stocks will come back into favor, and a lot more liquidity will move from the sidelines into the debt market, with this little bit of pressure on saying, listen, you might even get a lower rate in the next meeting, or you'll not get a higher rate than this. But bond yields, you saw just last week, RBI had to refuse the treasury bill in the auction, reduce the bid. So it's not that, bond market reacts to various positions, but I don't think longer term, you can keep the rate down the way artificially, because inflation is up. It's even an RBI thing is 5.4, but it'll be upward of 6.5%. So yeah, allocation strategy remains the same. Whether you want to lock in all of it now is a question that you can do, but quite a bit you lock in because RBI is in a mood to slam the interest rates down. So, and you live in an insulated economy, so no choice but to follow. So book your fixed deposits now rather than waiting for another month or so.
Okay, you have been talking to us about, just getting into the fixed deposit space for a while now. Ajay, do you think it's too late for gold? Have prices already run up way too much to get in now?
You know what? I keep saying this to everybody. It's never too late for anything, because if you're born and you started earning income today, you cannot imagine that you'll get gold at 50,000 or 10,000. I bought gold at 6,000, at the end of the day. So, that is one asset class which you need to keep adding up. Don't worry, it is 60,000 rupees today. Tomorrow it may become 50,000. You add 50,000 and just don't worry about it. So for a person who's coming today, what does he do? Does he wait for 50,000 and he waits and he waits? Or does he start saying, okay, my allocation is 5 to 10% of my portfolio. Let me put at least 1% in the market. So I don't think we should wait for gold, because every single central bank in the world is buying gold at this point of time. There's nobody selling gold, right? That's the bottom line. And it's not like infinite supply. So I would still recommend keep gold in a portfolio and keep buying that. And India offers a beautiful bond. That's the best thing you can offer in the world is the Indian gold bond. It can't get better. You get interest on that. You got capital gain exemption on that. And you get a direct thing in a paper in a depository account. So gold is for keeps, guys, and just keep adding up. And believe me, if you had followed your grandmother's advice, a lot of investors would have been a lot richer today.
Well, if you'd followed our grandmother's advice, you'd have been better in so many ways, right? Financially is one of them. Ajay, how is real estate in your part of the world doing? I keep getting these messages saying, recently another project was launched and was sold out. Demand seems pretty good on the real estate front. Good projects?
Fantastic demand, absolutely fantastic demand. There's no doubt about it. And but the same problem, Prashant. 90% of the demand is actually investors struggling to find returns in the market. That's the bottom line. And our belief, if told our investors, if you're buying real estate today at these prices, you will lose money in the end. It's crazy pricing, it's outrageous pricing, and it's not going to give you returns. So whatever had to happen has happened, your repricing has happened. But if you're in the market today to invest in real estate and make a return out of it, I think you'll be sold a lemon today, this market. It's elevated beyond all norms. It's elevated to the point of unaffordability. It's all investors, investors, investors. The recent project launch, for instance, which you're talking about, without naming it, 90% of people were investors, maybe 120% are investors, right? So there was no real demand of the guy who wants to live in that part of the town paying this kind of outrageous money. He can't afford it at the end of the day. The guy who can afford that is living on the other side of Gurgaon, okay? And therefore, he said, okay, let's put the 20 lakh chain, let's get a deposit at least in, and if we get an allotment, we will see what to do with it because I have to pay over 4 years. So, yes, demand is good, but a lot of it is now pure investment flow. And you know how, when the real estate investment flows start, what happens in the end? You pay heavily for your price. So I would not recommend buying anything in real estate at these prices today, no matter which part of the country you're in. It's crazy, absolutely crazy. And well, if you have to move somewhere, live, you have no choice. But if you're investing, certainly you're investing at the peak of the market for the next 5 years.
All right, Ajay, we got that. Definitely,
Thank you very much.
Advising against getting into real estate. Thanks a lot, Ajay. It's been a pleasure speaking to you and having you on the show with us. With that, we do need to get into a short break on the show. The market is holding up with a 40-point gain right now. The Nifty Bank 250 points in the green. So take a short break. When we come back, we'll get you a check on the technicals. Ashish Kayal will be with us.